price gains in gold to date have been primarily driven by central banks, who are strategic buyers, and by non-Western investors whose trust in the Western property rights and arrangements in our system and the ability of the United States to project its power and remain a hegemonic superpower in control of the financial system and control of the dollar system is declining on the margin. This is not a collapse. I mean, we're not talking about that. We're not even talking about yet a run on the bank. We're talking about a walk on the bank.
In a world where trust in Western financial systems is quietly eroding, gold's steady rise isn't about speculation. It's about strategy. According to investor and wealth preservation expert Simon Mikhailovich, today's price gains are being led not by retail excitement, but by central banks and non-Western investors seeking safety outside the dollar-dominated system. Their confidence in Western property rights and global financial dominance is waning, not collapsing, but enough to start what he calls a walk on the bank, a subtle yet powerful shift toward real assets. It's a reminder that wealth preservation today isn't panic-driven. It's preparation. For more insights like this, stay tuned. And don't forget to like and subscribe.
China came out with proposed or whatever export controls starting on November 1, which essentially it's a bit of a declaration of war. It's I don't know. It's an opening of a new front in the trade war, and under these new controls, China would essentially grant export licenses. You would need export licenses to bring out all sorts of goods, spare parts, and rare earth minerals, which are essential to electric car makers and every defense manufacturer we know. So it's mission critical. I mean, these are mission critical items. It so happens, I've looked it up, I mean, it would take the U.S., 2 to 5 years, on the best of circumstances, to replace that, and maybe longer. And this is only this fast if all regulatory approvals are sort of short-circuited. So this is a very big shot across the bow. I mean, it's major. In response to that, and by the way, when they put export controls, it means that whether it's a rototiller or tractor or whatever machine stops working, needs spare parts, you have to get a license, export license from the Chinese government for your machine to be repaired. So this is huge. It's control over everything we have, more or less. Okay, so in response to that, President Trump announced or threatened 100% tariffs on China. Crypto suffered biggest losses ever. Stock market took a huge dip. By Sunday, this company, this Nexperia, was taken over. That's a shot back, in my estimation. And President Trump was already softening his language, and so was Vice President Vance, trying sort of, I don't know whether you want to call it backpedal, soften, whatever, to negotiate. We can negotiate. There may be a ceasefire, and they may make some deal. But it's like in certain relationships, whether it's marriage or whatever, when certain words are said, it's impossible to take them back because the mask comes off. So the consequences of us using what we called at the time, we Americans, nuclear sanctions against Russia, including freezing of the Russian reserves, has dealt a major blow to confidence in the rule of law and the sanctity of property rights held by other countries and individuals who come from potentially not immediate friends of the United States and the Western Alliance in the Western financial system. And part of the significant increase in the purchases by central banks, in this case, both inside Europe and outside the West, I think has had a lot to do with that situation that happened in 2022. So it's been 3 years. And we have seen blistering pace of purchases of gold, a significant increase, and we've seen it more than doubling of gold prices. But if you look at the gold ETFs, the reason gold ETFs are a good place to look because it's the information is public. World Gold Council publishes monthly both the flows and the assets under management in gold global and both broken by North America and Europe and Asian ETFs. But the important measure there is the tonnage, because the tonnage indicates shares outstanding. Now, the reason these ETFs are interesting, because this is most of the, if you understand the structure of the investment management business, particularly in the West, most, other than hedge funds, most traditional managers have a mandate to buy stocks. They don't necessarily have the mandate to buy physical gold, and they often don't have the mandate to buy futures. So positioning of portfolios in the exposure to gold price is usually done either through gold ETFs or through mining shares. Well, okay, we know that the mining shares have been screaming higher, but pure gold exposure, gold ETFs. So if you look at the tonnage in gold ETFs, which speaks to shares outstanding, and let me explain what the meaning of that is. As the price of gold goes up, the assets devoted, the value of the holdings in ETFs is increasing. And so just through AUMs, assets under management increase, the share of gold in portfolios that hold exposure through ETFs is increasing. So the latest number, I think from the Bank of America survey, is that the average exposure is 2.4%, and that's up double because of the price of gold is up, okay? But when somebody sells an existing share of an ETF and some other portfolio buys that share at any price, however high the price is, there's no net increase in portfolio exposure across all portfolios, because whatever gold exposure came out of the seller is just entering the buyer. So the real change occurs, just like with funds, subscriptions versus redemptions, the flows. When additional buyers arrive and there are not enough shares already in the market, and that's when the authorized participants who manage these ETFs, essentially market makers within these ETFs, they have to buy more gold and issue new shares, because each share of an ETF is backed by not a dollar amount of gold, but a quantity of gold, whether it's an ounce, a tenth of an ounce if it's a GLD. So now with that in mind, as of the end of September, which is 2 weeks ago, less than 2 weeks ago, the tonnage in all global ETFs was still 2% below where it was in October of 2020. And it was barely 20% above of where it was in December of 2012, okay? So what this says is that Western investors are just starting. Now, the flows, if you read, the flows into ETFs have been heavy and positive, but that's because a year ago, the tonnage was down 20% from 2020. So now there have been enough inflows to catch us up back barely. It was 2% below. So I'm sure by now, 2 weeks later, we're probably there. But on the aggregate basis, across the Western portfolio investment universe, there's not a tremendous demand for physical gold from Western investors. I just saw his interview on Fox, just posted yesterday. And as a part of that interview, they were talking to people on 47th Street, the gold dealers. They're having people coming selling gold to them, not buying. The premiums, I just looked at the coin premiums, they haven't budged. There are no lines around the block to buy gold. The attempts of a gold to sell off have been met with massive buying. Gold has not been able to go down for months now. It's sort of pulled back a little bit in the spring. It didn't go anywhere really through the summer. And since the summer, since it started running, it just hasn't been able to go down. Because every time it goes down a little bit, there's a bid. There's a very strong bid. And I believe that the bid is strategic. And the reasons for the bid are what we're talking about here. And so the future of gold and future of gold price and demand for gold is not about that.
As global tensions escalate, gold's rise tells a story far deeper than market speculation. With China's new export controls on critical minerals, a move seen as opening a new front in the trade war, the world's supply chains and financial stability face renewed strain. The ripple effects are already visible: tariffs, market dips, and a growing mistrust in Western financial dominance. Strategic buyers, particularly central banks, have been accumulating gold at a historic pace, while Western investors remain cautious and underexposed. This shift signals a rebalancing of global confidence, away from paper promises and toward tangible value. Let's get into the interview.
See, the difference between paper gold and physical gold is the confidence in the counterparties, right? If those who seek, like ETFs, those who seek exposure to gold and who want to ride the price train, the appreciation, which is a financial trade, they're happy to hold paper. I mean, they're happy to speculate in futures and ETF shares or LBMA contracts, whatever. However, as confidence decline, I mean, we're seeing this in the silver market. I mean, at some point, the moment of truth is when the spot market takes over. So the spot market is when somebody calls and says, "I'd like to buy X." Just like when you go to the store to buy milk, you're not putting in an order for milk to be delivered 2 months from now. You're not giving your money to the cashier unless the milk is given to you in exchange, right? So it's the same thing in the spot market. When you want to buy physical gold, when you essentially want to transfer your wealth or exposure, you want to get rid of counterparty risk. You want to take immediate delivery. That's what spot is, on the spot. Well, that's the moment of truth, when enough people have low enough confidence, where this it's a curve, where there's a cross from, well, it's like, slowly and then all at once, right? It's that kind of dynamic. And so when that happens, either there is gold to deliver or there isn't. And it's important to understand, people maybe not thinking about it, but the common sense thing about gold is that you're not just buying if somebody wants to buy gold, I mean, it's not some theoretical gold, it's actually a manufactured product. There's a whole industry, refineries that make bars, and there are mints that make coins, and they have throughput capacity, and they have raw materials, which comes from recycling in the mines. And so just like with toilet paper during COVID, I mean, it's not that there are not enough trees in North America to make as much toilet paper as we ever want. It's just, it takes time to make it. And the inventory on hand may be depleted very quickly. And that's where parabola of price arrives. So the dynamic that we're confronting here, the risks that not certainties, risks that we're confronting here are in that family. So, for example, everybody says there's no replacement for the US dollar because of the depth of the markets, because of the system, because of the technical reasons. But if there are strategic national security reasons for other people to suddenly go the other way, it's not a matter of convenience or financial feasibility. It has nothing to do with that. It's a matter of national security. I'm answering your question because what you're asking is about gold confiscation. It's a extremely low probability event whose probability, by the way, it's not just gold confiscation. It may have to do with capital controls. It may have to do with all sorts of, access taxation, controls on, certain assets you may or may not own. Like during 2008, you may remember they prohibited shorting certain securities. So an extremely low probability event will remain low probability or zero probability unless certain things happen. And when certain things happen and financial problems become national security threats, there's really no telling what can happen or how far governments would go to protect the situation. And by the way, you can think about, again, I'm not passing judgment on any of that. I'm just, as an analyst, trying to describe what I see and make observations about what the situation is, whether it's good or bad or indifferent. Like sending troops into the cities, is a very unusual thing, but you can see that why the government may want to have this well rehearsed and done if you do have a financial crisis, if you do have a market crash. And we mentioned the problem with the market crash. 10% of Americans account for 50% of the spending, and that's the same 10% of Americans who pay 60% of federal income taxes, and it's the same 10% of Americans who own 90% of the stocks. So the entire economy is levered, completely levered to the stock market, and the federal revenues are completely levered to the stock market. And the spending, 50% of the spending, is levered to people who are extremely sensitive to the stock prices and to the level of taxes. I mean, this is a very unhealthy situation. Okay, so it's not that this will happen. It's if that happens, the chance of this happening becomes much higher.
In times of uncertainty, the true value of gold isn't just in price, it's in possession. As confidence in financial systems weakens, the difference between paper gold and physical gold becomes crucial. Paper assets like ETFs and futures depend on counterparties and promises, while physical gold delivers immediate, tangible security. When enough investors seek real delivery instead of exposure, markets face a moment of truth, where supply struggles to meet demand and price moves can turn parabolic. This isn't fear-mongering, as it's risk awareness in a system stretched thin. As financial fragility grows, gold remains not just a hedge, but a statement of independence. For more insights like this, stay tuned, and don't forget to like and subscribe.